Welcome to the daily update, where I'll go over the action in the market for Friday, May 17th, and then we'll see how things look for Monday, May 20th. A pretty slow day, a very surprising day in that it was options expiration, so we see a lot of squaring up happening, but we were still below average with volume, and that's been kind of the trend over the last week or so. We had one day when CPI came out that we got almost up to average, but this whole past week, as we've been going higher, we have been below average with volume, which is a bit of a concern. As we've been going up, we've been seeing volume dropping off. That's a warning sign. Doesn't seem to be causing a real problem right now. We're still looking quite positive, but in the long run, we want to keep an eye on this to see if that's going to continue. Before I get started, please know that on June 3rd, Monday, I will be locking down the videos. So right after I post them, they won't be publicly available. They will be publicly available right after the close for the day that I post the video. So if you wait until after the end of the market to watch the video, you'll still have free access. I'm still going to have the weekly videos available as I post them. So that part is not going to change. If you want to have early access to the videos and only the videos, that will be $19 a month. There's also a membership program that I have, and there are some videos on both my YouTube and Rumble channel that you can go through where I talk about the things that are in that program. That will be $97 a month. And that's not, you don't have to pay the $19 extra if you're a member. That's included for the membership. If you want to talk to me about this, please feel free to send me an email. I have an email right here at the bottom. If you like that, don't like that, if you have any ideas or feedback, I've been getting some really good feedback from folks and really enjoying some back and forth. And I hope that that will continue, and you're more than welcome to do that. So let's go back as soon as I get through this slide and talk about what happened, and then I'll go through the charts. We did have a lower open, right, to start off with, but prices just chopped sideways above and below the unchanged level. So not an awful lot of conviction either way. We chopped sideways for a while longer, and then prices ended up falling down to S1 at 52.87. Then we climbed back up to the unchanged level, and we closed slightly positive on the day. So not a lot of conviction behind the moves throughout the day. We were up 0.12% on below average volume. Again, surprising because it was options expiration. We're still positive in the short, intermediate, long term, and then I'll be doing the weekly video over the weekend. We are looking overextended right now, but we're not really pulling back from that, so that still suggests good momentum. The perma bears are coming out predicting massive declines. Our charts are still suggesting that things are looking really good for right now. As I always say, if we start to see some selling into strength, or if we see a more significant pullback, then that's when we're going to really evaluate things. But for right now, the market is looking pretty good. Now, seasonally, we're through kind of a negative time right now, but then we sometimes see a little bump up going into the latter part of May. And then also seasonally is when June, July, and August are pretty positive for tech, and that could help the market go up from there. I'm not saying that's what's going to happen, but that's what we're looking at when we look a little bit down the road with things. And then we want to keep an eye on all the different geopolitical things going on to see if they have an impact on the market. Some comments. The Dow closed above 40,000 for the first time, and there are people wearing hats that say 40K and all that. So yeah, that's a milestone. When I first started in the markets, they were wondering if the Dow would ever get over 4,000. And that was a big deal when that happened. Now we're at 40,000. So that just tells you over a period of time. And you can listen to folks and say, yeah, the market's artificially pumped up, that there's a manipulation that goes on with the economic reports. Yeah, all that stuff's true. But the stock market is still a great place to be able to have an opportunity to buy low and sell high, and sometimes sell high and buy low, and even take advantage of things when we're chopping around, not really doing too much. So this idea of people coming out and saying negative things, it's actually healthy for the market. The perma bears, I mean, they have their straight arrows down for their Elliott waves and they're straight arrows up for gold. Well, they're kind of getting gold right, but they've been getting stocks wrong for, well, 20, 25, 30, 100 years, however long you want to say that. On a short-term basis, we have the Stochc RSI, Williams percent R, CCI 14 and 20, the stochastics, the slope oscillator, and the boom indicator based on 20 periods. And then finally, the RSI 9. So this is pretty much the same list. We haven't really worked off any of these readings. And as I like to say, yeah, we're overextended, but this right now is looking like pretty good momentum. If we see this list start to shorten and if we're starting to go down, that's when we'll just try to evaluate the climate and see, is it turning more negative or are we just kind of hanging out before we're getting set to go higher? Intermediate term, we still have the CMB composite, the standard deviations chart, the TTM squeeze, the Sean trend meter, and our 10-period moving average study of the S&P new highs minus the new lows. And longer term, we do have a new addition here. We have the 150 and 200 period moving average. Those have been on the list. Now we're starting to get a little bit extreme when we look at our 200 period moving average study of those stocks inside of the S&P. And again, something we want to be aware of, but is also suggesting good momentum. That means that 80% of the stocks in the S&P 500 are above their 200-day moving average. That's a positive thing. The scenario has not changed for right now. Oh, I did change it a couple of days ago, where right now it looks like the Fed is going to leave rates higher for longer because inflation, even though this last CPI report was more friendly to the market and the market really was well receptive of that report, we need to see more follow through with the economic reports to see if inflation is actually coming down closer to that 2% target that the Fed is trying to achieve. Now they're looking at September as a possible time for rate cuts. And I'm going to be showing that in the weekly video. I'll be looking at the next meeting, the meeting after that, and then the meeting in September to see what the probabilities are. And that's going to change every day. And the Fed is also decreasing quantitative tapering. In some ways, you could turn that over a little bit and say maybe that's quantitative easing to a little bit if they're actually coming in and buying things. But the market really likes this, that they had been letting things fall off their balance sheet. Now they're not doing that as much right now. And that's been giving some real stimulus to the market. The dollar was up and interest rates were also up. We closed at 4.42% for the 10-year yield, where after Thursday, we were at 4.38%. We're still inverted with the yield curves. Sentiment is getting more positive now as folks are going, wait a minute, this move, I missed it. Stocks were supposed to go down. I heard all these doom and gloom predictions going on out there. That's what can happen with a lot of up moves. They start kind of in stealth mode. That's why I watch so many different things and have so many charts in the video. Yeah, it takes you longer to evaluate things, but then you have a better clue as to what's going on. And you can see things develop. And then as we continue to look a little bit better, we see more and more and more confirmation of that. And then we can kind of go with it as it's starting, build on that as we're seeing more confirmation. And then we're already in by the time we're really starting to move up, where a lot of people, especially like in 2022, when we would see something like this happen, about the time everything confirmed that we were in an uptrend, we would hit overhead resistance, turn, and then go down. And the move was over and people were getting in at just exactly the wrong time. Where the approach that I take, we try to look at this and look at subtle little changes that are happening, and we can take advantage of those and then ride those waves up. Well, we had gone from being negative over to fair with sentiment. Now we're actually starting to turn positive, and we still have a ways to go from a sentiment stage to see, are we going to get even more positive over this before are we going to get even more positive because of this? And then eventually get to an extreme positive reading with that. So we're at 65 and we're positive right now. We are positive with our trend. It's showing some strength now. The ADX is above its moving average and it's starting ever so slightly to cross back above 20. We are positive with the bias. It was just barely an up day, but I switched it over to positive anyway. And the momentum continues to be positive. Economic reports. And I have a whole list here. Actually, I don't. That was yesterday. I have a short list here. I just have this one, and then I'll show you the chart that goes with that. The leading economic index, it was down 0.6%. It was down more than the 0.3% that they thought. And last time we did see a reading of down 0.3%. All right, here's the chart. And this is actually looking better when you look at a longer term picture of this. We follow the blue line, which is a 6-month growth rate, and it's starting to come back up, and we're coming above this red line. Usually when we drop below this red line, that's when we're going into a recession. You can see other times when that happened. Well, we came down and we're starting to go back up and show more strength in this chart. And we haven't, to this point anyway, gone into a recession. Now, at some point, that is likely to change, and we're probably going to go into a recession. But this time, this idea of a soft landing is seeming to be legitimate for the time being. We just want to keep watching things day by day to see if that ends up changing. Some blog charts here. We show the NBER, and this is the group that officially declares whether we're in a recession or not. And there are, if you're a member of the program, I do some videos talking about the different reports that go through to suggest these are reasons why we will likely go into a recession versus the reasons why we won't. And we just kind of make a case for either side and then watch out and to see how it plays out. And it says this is recession dating, because if we get back to the point where we're not inverted with the yield curves, that's usually when the countdown starts to see if we're going to go into a recession. And so the NBER, they come out with these kind of announcements type of things just to let us know if we're heading into a recession. And over here in this little box, and it's kind of hard to see, these are the different dates when we started to date the recession, and then how long the monthly lag that we saw here, whether it was 6 months, 5 months, 10, 9, 12, or 16 months. So there can be a real lengthy time between when it looks like we might go into a recession and then when it actually happens. And then you can see this is why we are so concerned about a recession, because we see some real negative returns with the market decline. I think it peaked to whatever the decline was here. And that's a pretty negative time for stocks. And there's always the debate going back and forth. Yes, we are. No, we aren't going to go into a recession. Then looking at the financial asset allocation across households, the takeaway from this is, yeah, folks have debt, folks have cash, but still the main investment that people have are equities, and that's stocks. And right now it's coming in at 52%. Now that can include mutual funds, pension funds, foreign investors, and so forth. But this just means that the stock market is still seen as the best form of making investments. Whether you earn money or not, that's the part that's kind of the variable. And then cumulative gold flows, just because gold is kind of the rage these days. And it just shows the flows by private investors and central banks, where this dark blue line is showing bars and coins themselves. Now, this is physical gold. This isn't GLD. This isn't futures contracts. This is actual physical gold, and how the central bank purchases have really been going up since March of 2022. And this is giving some real support to the market. But we're actually seeing the flows going out of ETFs right now, which is kind of strange because other charts that we look at show that money's actually going into ETF. So kind of getting a little contradiction there. And then small cap forward PE ratio. Again, I use the Russell 2000 and the small cap index as a point of analysis. It's nothing that I actively participate in, but this just shows what's the forward PE looking like. And I'll go over this again, and I'll show this same chart in the weekly video, where we're coming in under this 15 level. So we're underneath the fairly priced. Now, just because something is fairly priced doesn't necessarily mean it's a good buy. You might go to a store and something's really on sale, but if it's a terrible product, you don't care how cheap it is. You're not going to buy it anyway. We're still waiting to see if the environment's going to switch over and be more friendly to small cap stocks because they're the lagger right now. And if they really take off and start to go up and get to the point where they're actually outperforming, then that's changing the market climate. But we're not really seeing that a lot yet. There's been a lot of false starts, especially when we thought the January effect was going to happen almost 6 months ago now. December looked great, but then January wasn't very good. So we're just waiting to see what will happen there. And then looking at the expiration of what happens, there's a lot of SPX. Now, these are options. They're a lot more expensive options. They're a different kind of options. They're European style options where they expire. It's really kind of crazy how this works. You stop trading on Thursday, but you don't get the final price until Friday. And that can be really crazy. But those are a lot of options that expire. And at this point, it was 1.1 trillion. Then we have non-S&P index options that are expiring, SPY options. And these are mainly the options that I deal with the most. And then you have the PM version of the S&P options that also expire, non-SPY ETF options, and then single stock options. These are like options on Microsoft and Google and so forth. And this is just the amount that is happening. And you've got all this stuff expiring that can really have an impact on the market. And with all this stuff happening and squaring up going on, and we've been going up lately, that's why I was really surprised that we were below average with volume. And we also keep an eye on this: privately owned housing units and authorized in permit issuing places. When we top out and start to come down, a lot of times that's when we're just right on the edge of a recession, or we end up going into a recession. We topped out over here, and we're starting to come down, but we're not necessarily spiking up at this point. So this is just another chart that we want to keep an eye on because housing is such a huge part of the overall economy. One chart that I saw here, and again, this is a chart that I show, but this is a different look at kind of those same things using the moving averages that I usually look at, and then some different levels here and projections going forward, showing that we could get up to about 56, I think it's 5,600, 5,560. It's really hard to read that number right there. But if we, come down, bounce, and then are able to come back up out of that, or if we just break right on through and go up to that level, yeah, it doesn't mean that's what's going to happen. But the technical picture is still looking quite positive for the market right now, unless we start breaking down through some of this pretty significant support, and that could change the overall climate. Our intraday chart, very slow day here. We had a bit of a lower open and we just chopped along the unchanged level. It looked like we were trying to make a break for the downside later in the day. We came down to S1, but then we bounced up off of that and actually ended up closing positive. And you could even say, well, we were pretty much at the high for the day, but the swing between the high and the low was so small that really doesn't mean all that much that we closed near the high. Here's our intraday chart, not really much significant that occurred. And I'm kind of making this a little bit longer term to give you a bigger picture of this intraday chart. We are seeing where value is beginning to overtake growth. Now, the blue line had been above the red line. That's growth is the blue line. Now we're seeing value start to outperform on an intraday basis. And this is one area that we're not seeing a real significant improvement in. We're also declining with the growth to value ratio with the S&P 500 on the intraday chart. So end of day, we were up, but up a lot less than we were with value with the large caps. They were up more with the mid caps and down less with the small caps. So here's our end of day chart. Small cap growth versus small cap value, ticking up a little bit, but not really showing any strength. Not what you would normally expect to see when we're at or near all-time highs with the S&P 500. We actually declined a little bit with the mid caps, and we declined slightly with the S&P growth to value ratio. So this is not a real area of strength. That's what we're trying to figure out. Are we shifting to a different type of climate where maybe growth doesn't have to outperform value? We're waiting to see if the small caps kick into gear. We've got utilities and staples doing really well. That's usually not what happens at market tops, but that's a concern from a logical standpoint, but I also showed a chart that I'll show again over the weekend where that doesn't necessarily mean bad things for the market either. We're just wondering if what the market is focusing on is shifting over to something else. And that takes a while to figure it out what it is and then watch it develop. And we came down just a little bit with our growth to value ratio here. We're still inside of the rainbow. Discretionary is not doing all that great either. Still in a longer term uptrend, but it just kind of ticked up a little bit. Large cap growth is hanging in there. It was barely up 0.03%, not to set a new all-time high since it had been down, but it's very near its all-time high. The Wilshire was up slightly, not at an all-time high, but still close positive. And our trend is starting to improve. We're just barely above 20 now with the black line. That's the ADX, and we're coming above the moving average. The green line is on top, and even though it declined, we still would default to positive here. So this is looking like it's a positive trend that is now starting to get stronger. We also see that in the short-term chart. The ADX is above the moving average. The green line is on top. But we're continuing to really drop off with volume, and that is a concern. Sentiment, we really dropped off with the Ulcer Index. It had been going sideways, and it really fell lower, showing that there's just not a lot of fear, according to this indicator. We did get this reading a few days ago, where we're slightly above 3 with investors' intelligence. That's when folks are getting a little happy. If this continues to go up, then sentiment may be getting extreme positive. We really declined with the VIX, with the line chart as well as the bar chart, and we're coming way down to this really low level with the VIX. And this is typically when we see good returns for the market. I don't have the Tom Bowley chart to show you, but when we drop down below 13 with the VIX, that's when the market sees its best annualized returns. But we picked up a little bit here with the VIX of the VIX. That did go up just a little bit with the bar chart and the line chart. The momentum of the VIX continues to be down. You can see we've actually dropped below 12. This is the lowest reading. We got to this back in December on an intraday basis, and we didn't close at that level. But the fact that we're dropping under 12, that's a very low reading for the VIX. Could show complacency. It could also show confidence. The equity put call ratio did decline on the daily chart. And after ticking up a little bit, now we're starting to go back down with the 5-period chart. Volatility risk premium was pretty much sideways, but it came right up to the band, started to fall, and then ticked sideways on Friday. This fear chart, excuse me, this fear chart did tick up just slightly. The other fear chart that we look at did decline. We're looking better here with the advanced decline line studies. We're breaking out above this previous high based on price. And we're actually looking a little bit stronger based on volume. Where volume had been lagging, according to this chart, now it's starting to actually lead. With the new highs, new lows, it dropped off from what we saw before, but we're still going up with the 5-period and the 10-period. Another internal measure showing that the S&P is looking strong. The advanced decline ratio is still positive, both with the 19 and the 30-day moving average study. And we ticked back up with accumulation distribution. If we can get back above or if we can keep going up and stay above the moving average like we did, this was the run up that we saw from November until about the middle of March. Is something like that going to be able to develop over the next few months? Seasonally, it may suggest that that will happen, but we can't take anything for granted. We have to watch it unfold and evaluate it each day. The Chaikin money flow is also looking positive. The Chaikin oscillator is positive. We're going up with the cumulative NYSE advanced decline line as well as our regular advanced decline line. And we actually tick down just a little bit. If I go back here, you can see just a tiny tick down with this NYSE advanced decline line and a little bit of a tick down with this other NYSE advanced decline line. But taking in a little bit of bigger picture, this is still looking quite positive. And when we look at common stock based on price, we tick down to sideways a little bit, and we actually tick back up a little bit based on volume. S&P, cumulative advanced decline line based on price, still looking pretty solid, also looking even a little more solid now based on volume. All of our advanced decline line studies were above the moving average. We declined a little bit with the mid caps and the small caps, but for the most part, The fact that they're above their moving averages is positive. Our chart here, where we didn't set a new all-time high with the S&P, but we're still kind of dancing around. If we continue to go up, we do have some pivot points above current price that we'll want to be aware of. And as I usually say, this isn't the only resistance we keep an eye on. This is the only resistance we're seeing on this chart. And we were below average with volume, which again, to me, was quite surprising since it was options expiration. With our short-term indicators, we are still extreme positive with the Stochc RSI, the Williams percent R, the CCI 14, and the CCI 20, as well as our stochastics. Now, stochastics altogether are short-term, but then I further subdivide it by going short-term, intermediate short-term, long short-term. We're extreme positive there as well. The boom indicator is still extreme. We're getting a little far away from that 20-period moving average. We're just barely underneath this line to see how far away we are from the 50-period moving average, and we're still looking positive with the distance away from the 200-day moving average. When we look at our double and triple exponential moving average based on 20 periods, we're going up, and now the green line is still below the blue line. We want to see the blue line cross back above the green line, because that's the triple exponential moving average and it moves quicker. But this is still positive, and we're coming out above all of these lines as we've been going up. Looking at our moving average study, we were flat to slightly declining with the 20. We turned up just a tick on the 50, and we're continuing to go up after flattening out with the 200 period. Actually, we're looking a little more flat here with this study. The force index is coming down just a little bit, but is still above zero. It's still positive. Here's our regular simple and exponential moving average, where we're showing a lot of improvement here in the short term. We are in the +3 channel with our standard deviations chart, so that's a little extreme positive. But you can see when we were having the really good run up, we can stay up here for days when the market gets really good momentum. Other times we get right up into this area and then we see a pullback after that. Intermediate term, we're still positive with the balance of power. The go, no go is positive with the darker blue bars. The highest high value is also positive. We're seeing the blue line going up, and the midpoint is also going up. The TTM squeeze, we're starting to look a little extreme. So to give it some context, I have a longer version of this chart. And what I did to put this black line, I just kind of look at some of these tops, and then where we topped out and went down quickly after that, that's where I decided to put the line here right at 150. And we're getting above that level now. But for the time being, it can still go higher than where we're at right now. It's when we start to come down, that's when it'll start to look a little more negative. And then our double and triple exponential moving average based on 50 periods, we're above both the lines. Now the red line, if we stay above this, could eventually come back and cross above the blue line, and that would be more positive. The CMB composite now for 5 days or whatever it's been, we're coming down, but we're still extreme positive. There's our 50-period moving average study. We're well above these for right now. I'm still showing this chart to see the action of the blue line versus the red line. If we can get the blue line to cross above, that would suggest the intermediate term is turning more positive with more conviction. The ease of movement did decline, but we're still above zero. The Erin indicator is positive. The oscillator is above zero and still looking good there. We're not extreme, but we actually ticked down a little bit with the S&P McClellan oscillator. But since we're above zero, that will help the summation index, the next chart. So we're continuing to go up based on price, and we're also going up based on volume. So this is more intermediate to even longer term intermediate, suggesting that we are still looking quite positive. And we could look at differences between these charts where we're starting to come back to this previous high based on volume. We still have a ways to go based on price. That could end up being positive because we're seeing volume slightly outperforming price. The NYSE McClellan oscillator also declined, but is still above zero. So the summation index based on price and volume for the NYSE, they continue to go up. Swenlin trading oscillator, this is a bit of a warning sign. We're seeing it coming down based on price, but with the up day, we're turning back up slightly based on volume. So a little bit of a discrepancy here. Now, taken together, this chart is still positive because we're above zero with both. On a momentum basis, we are still positive with the PMOs. We're coming down a little bit with the PMOs that are rising. The buy signals are leveling off, but still going up. And we're seeing a little bit of an improvement here with the PMOs that are above zero. We've remained at neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR chart since the dots are underneath. The slope oscillator kind of starting to roll over a little bit here, but still positive and possibly extreme positive. The MACD is still looking more solidly positive, and that's more of intermediate term, while the slope oscillator is short term. So looking at our oscillators, we're rolling over a little bit with the slope. We're still going up with the TSI. These are the two short-term oscillators. We're still looking positive in the intermediate term when we look at the MACD, the PMO, and the PPO. We're also positive in the long term with the TRIX and the KST. So momentum is still looking quite solid. Our moving averages, we're still above all the plotted moving averages, and we're starting to see some of them cross back above. If we can stay above that and see all of these lines get above the longer moving averages, that would also turn things more positive. The bullish percent index just still right under 70, but still looking positive. With the NYSE bullish percent index also ticked up, so that's positive. And the NASDAQ 100 bullish percent index, it's leveled off now, but it finally crossed back above 50, so it's still positive for the time being. The money flow came down a little bit, but is still above 50. That's positive. The ultimate oscillator is also above 50, so that's positive. The vortex did decline, but the green line's on top, so that's positive. We're just a little bit under 70 with the RSI 14. We did decline a little bit with the RSI 9, but we're still extreme positive. So the 14 is more short to intermediate term, where the RSI 9 is more short term. We're still looking better with the on-balance volume. We're above the moving average, and now the moving average is starting to turn up. The stocks above their 20-period moving averages did decline, but we're still getting a very high reading. We have over 75% of stocks in the S&P that are above their 20-day moving average. And here's a study, and I drew this little arrow thing in here now where we had a very low reading below 10. That's when we were going down. Now we shot up and got above 70, and we're seeing, at least to this point, the aftermath of some good upward move here. Now, we saw that about a year ago where the same type of thing happened, and you can see what happened after that. We don't go straight up. There are some pretty significant downtimes that might throw some doubt on the situation. We saw a similar thing back in October, but it gave us a false signal because this indicator didn't get above 70. But when it came back down, that produced a positive divergence. Then we saw a thrust up above 70, and then that's when we took off and spent the rest of the 2023 pretty much going higher. We're wondering if a similar type of setup is now happening on this chart. Now, recent history would suggest yes, but we can't just assume that. We have to keep watching things to see if that's going to actually follow through. Stocks above their 50-day moving average did tick back up and is above 50. That's also positive. Stocks above their 100-period moving average also going up, and we're just barely starting to get extreme. So we have slightly over 80% of stocks in the S&P that are above their 200-day moving average. That's showing good long-term momentum. The Copic curve is still positive. The Sean trend meter did tick down, but is still extreme positive. The Ichimoku cloud, the blue line's above the red line, and we're starting to clear the cloud here, and the green line is also continuing to go up. So this is looking rather positive too. We're coming down with standard deviation. As things have slowed down a little bit here, we're coming back down to the moving average. Standard deviation does not measure direction. It measures speed over the last 10 periods, and we had been really moving up. Now it's starting to drop off a little bit. The Pring bottom fisher is still generating a buy signal. And the mass index, again, maybe we're getting far away because we actually triggered a signal, and now we're seeing a lot of days pass since that signal was triggered. You know, that's why we use a lot of different charts, because I was interpreting this as a potential reversal, but it was the only thing we were seeing at that time. Now it may have triggered that we're going to reverse and really continue to go up. But we still want to be mindful of this in case we do start to see some weakness. On a trending basis, we are positive with the Heiken Ashi, we're positive with the Kagi chart, we're positive with the Renko chart, and we're positive with the 3-line break chart. And then I got rid of that weekly chart with the resistance level. I'm going to stop showing that for the time being because we're more than a couple hundred points away from that 5110 to 5111 level. But we're still looking either good on a momentum basis with our 150 and 200 or extreme positive. We're still positive with the Keller market model across all the indexes and different time frames. We're still looking more negative with bonds based on price. We were also negative with the dollar, and the dollar was down slightly. No, it was up. It was up slightly on Friday. No change here. And I don't know if somebody has to come in and actually change this or if it switches over automatically. We saw more blue and one red here. The industrial sector with the bullish percent index, it crossed below 70, but we did get the S&P back above 5,300. The NASDAQ got above 16.7, and here's when the Dow went above 40,000 and the party time started. Here's the one-day chart or one-day section of all the different sectors. Energy ended up having a good day. Materials, discretionary improved, but we need to see more follow-through. And the area that was down, staples and tech, ended up being negative on the day. Looking at the equal weight, that's the red line versus the regular S&P weighted index. Not really seeing any major divergences now, and didn't see much of a change in our ratio between the two. We've been chopping around as more the broad market has been participating. We're not seeing these really big upward moves showing that the bigger stocks are outperforming the rest of the market. When this is chopping sideways, that means they're both kind of performing about the same. The Dow, here it is, above 40,000. Who would have thought that ever would have happened? The diamonds still remain neutral, though, with the Elder's Impulse system. And we were down slightly with the NASDAQ. We're also down slightly with the NASDAQ 100. We're neutral now with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. The Qs, we're looking better here. When we look at this blue line, it may cross back above the red line, meaning that the 20-period moving average could get to the point where it crosses above the 50. That would suggest the short-term trend is looking positive, and we see more of what we saw earlier on with the blue line, then the red line on this chart. Small caps did decline after coming to the high end of their 2024 range. We are neutral with the small caps when looking at the Elder's Impulse system. Looking at the Russell 2000, we were flat but still positive with the RSI. We're still above the 50-day moving average, and momentum in the shorter term is still positive for the small caps. The mid caps were up slightly. We're still above this R1 resistance level. And this is still, since about the latter part of January, this has been one of the stronger areas of the market. And for right now, it's still holding up. The mid caps, though, are still neutral with the Elder's Impulse system. Apple was barely unchanged, up just 0.02%, and it's above its 50-day moving average. If we can stay above these lines, we might see the blue line come back up and cross above the red line, which would turn the trend positive. But for right now, it's still negative. Tesla was up 1.5%, still dealing with its 50-day moving average, still in a downtrend. NVIDIA was down almost 2%, but still above its 50-day moving average. Microsoft was down just a little bit, also above its 50-day moving average. Meta was down about 0.25%, 0.28%, still below its 50-day moving average. Amazon was up 0.58% and still above its 50-day moving average. And I'm including, because we're going with the Magnificent Seven now, here's Netflix as well. And there's probably some other charts. If you have any other ideas for big stocks that we could follow, please let me know. But I'm going to include Netflix. It's still above its 50-day moving average, but it's really been chopping sideways lately, even though it was up 1.73% on Friday. And the FANG index did see a little bit of a decline after finally breaking out from this sideways range that it had been in. Financial sector was up 0.73% and is looking positive. The staples to tech ratio is continuing to drop. Or excuse me, I need to back up. It had been dropping. Now it ticked up slightly in Friday's session. The dollar ended up being down slightly. Okay, I got that about 3 ways wrong. So, okay, we're at the 104.33 right now. Looking at the S&P compared with world stocks, the short-term relationship is still fairly strong. We're just kind of hanging on and actually going up just a little bit with the longer term correlation. The staple sector was down, but is still showing a longer term uptrend. And utilities were up, but little changed, but still just showing an awful lot of strength currently. The total US stock ETF was up 0.15%, so it's still looking good there. The 10-year yield, we did come up a little bit here, coming back up to the 50-day moving average, where we declined with the 10-year based on price. And looking at this ratio between 3 to 7-year bonds and stocks, it's continuing to decline, and that means that stocks are outperforming. Okay, the S&P 1500 compared with shorter term bonds continuing to go up, meaning that the broad market is outperforming shorter term bonds. And then we look at another broad market measure, and then we look further out with 3 to 7-year bonds. That's continuing to go up as well. And the Qs are back to outperforming bonds. And here's the soft landing versus hard landing scenario. It did go back up with this ratio. So that's still suggesting the market is anticipating a soft landing. We look at 1 to 3 month T-bills, which is cash, and compare it with 3 to 7-year bonds. This is ticking back up, and that's a little bit of a concern right now. We want to see this continue to go down. Possible positive scenarios. Not seeing an awful lot of improvement here with our growth to value ratios. Coming down with the Qs to S&P, still declining with discretionary to S&P. Came back down with large cap growth versus large cap value. So we're not really seeing any strength with the large caps, mid caps, coming back up to a declining moving average with both, well, with the mid caps and getting a little bit above it with the small caps. This is still looking positive though. This is our 10-day average of the S&P 500 highs minus the lows, giving us an extreme positive reading. If it can camp out here for a while, that will suggest good little longer term momentum. That it could be long short term or more intermediate term, since this is a 10-day average of the highs minus the lows. We're still looking positive here with our advanced decline ratio based on price and volume. And we're also looking good here with our 5-period moving average of the highs minus the lows across the broad market. This is continuing to go up. This is still a concern to us. The S&P to utilities ratio continues to go down. We want that to turn and go up to be more positive for the S&P. Staples, actually, after coming down, now it's starting to come back up. We want this ratio to go down, which would be more positive for the S&P. So what's our outlook for Monday? We're still positive, and you can say that we're extreme positive. And now that's true. Whether that's a good thing or a bad thing, that's what we're trying to interpret. Right now, it's looking like a good thing, but that could change at any time. We're not going to have any economic reports, and we're not going to have any economic reports on Tuesday either. So the market's going to be left to its own devices for both Monday and Tuesday session. And we want to keep an eye on all the crazy stuff going on in the world in case that impacts the market. Here's the economic calendar for the upcoming week. No reports on Monday or Tuesday, which is kind of strange. We're going to get the FOMC meeting minutes at 2 p.m. Eastern on Wednesday. And I highlighted jobless claims because that's kind of one of the bigger things right now. And then we're going to get durable goods and consumer sentiment on Friday. So still a little bit lighter week again as far as economic reports. Here's the calendar for the upcoming week, and I'll highlight them as we get to those particular days. One thing that's interesting is on Sunday, Fed Chair Powell is going to be giving a speech. And so we'll have to see if that impacts the futures. That I start following Sunday afternoon or evening, depending on where you're at. That's about 3 p.m. West Coast time, about 6 p.m. East Coast time. That's when the futures start trading. I'll just be watching that to see if anything that he says has an impact. Seasonally, we are blasted negative for Monday's session for the Dow, S&P, and NASDAQ. So seasonal wise, that's not looking like a very good day, but it's a Monday, which has been the most positive day based on what happened in 2023. We're now coming into the week after options expiration, where we typically see an up week. Now, we just can't finish the week where we typically see a down week. Are we going to see a flip-flop this week? But historically, we've been up 65% of the time and down 35% of the time for the week after options expiration. Here's our chart showing that we are seeing some seasonal weakness with the green dashed line even during an election year. And we might see this for another day or so before we go a little bit sideways. It's near the latter part of the month when we might see some positive seasonality coming back in. And then Memorial Day is going to be thrown right into that as well. And here is Monday, which is the most positive day of the week. And Tom Bowley still has us in this negative time for right now. Once we get beyond the 25th, that's when we end up seeing some positive days going into the latter part of May. So our warning signs, I don't know about this mass index. It was triggered. It was the only thing that could potentially be looking negative, and the market's pretty much been going up since that time. So this might end up being a non-signal, because not only have we been going up, but we didn't really see any confirmation of that from other indicators that we follow. We are at or near all-time highs with staples and utilities still remaining strong. We're still treating that as a warning sign for right now. And growth to value as well as discretionary to staples, they're not really showing an awful lot of improvement right now. Positive signs, I'm just going to tick off all these different things here. You can just pause this and look. I went through each one of these charts, so this is just a list to kind of give you it all together of what is positive. So our conclusion, we're positive and we're still extreme positive for now. And we can say that in the short and intermediate term. We're also looking positive in the long term. Thank you. I really hope you found this helpful. I will be preparing the weekly videos. So in the meantime, I hope you have a great weekend, and I will talk to you in the next video.